All right, everybody. Welcome. Thanks for joining us. Thanks for taking some time away from your lunch to join this webinar, a discussion about outlook for 2022 for the economy and for the markets. And we're calling this webinar the passing of the baton. And the reason we are is because, well, the economy grew by 6% in the first half of 2021 and is on track before the year is finished to grow at a 5% pace. And this economy, this growth that we've experienced has occurred because of two things: widespread vaccine availability and additional fiscal stimulus by the Federal Reserve. So you could say that we've had a hand up in 2021, and that's kind of helped us through this period of unique economic challenges. However, in 2022, the economy may be ready for a handoff and back to a greater emphasis on individual choices by households and by businesses, and how smoothly the passing of this baton is executed is going to determine the future course of this economic recovery. So that's why we're calling it passing of the baton. So when we look at the economy, let's talk about the economy, and let's talk about how, it's bounced back from one of the worst years since the Great Depression. And we've had one of the best years in nearly 40 years in 2021. And it's been a combination of, record stimulus, a healthy consumer, an accommodative Federal Reserve, vaccinations, and reopening of businesses. All of those contributed to a big year in 2021. And after what amounted to the shortest recession on record, only 2 months, March and April of 2020, the economy came roaring back to produce what is currently expected to be about a 5% gross domestic product growth in 2021, more than making up for the 3.4% drop we saw in 2020. Now, look, of course, there have been hiccups along the way, right? You can't shut down a $20 trillion economy and expect it to get going again without warming up, right? So the COVID-related economic shutdown caused supply chain backlogs, materials and labor shortages, and higher prices, all of which held the economy back to varying degrees. The good news is that that consumer demand is still very strong. And as these backlogs unwind, which might take a couple of years in some cases, we expect above average economic growth and a low risk of recession in 2022. So let's talk about the economy and our forecasts for 2022. So we expect continued growth, right? It's clear that last year's recession is kind of in our rearview mirror, and it may go down as the shortest recession in history, only 2 months. And as the US economy kind of moves into more of a mid-cycle, our 2022 forecast is for a 4 to 4.5% growth in GDP. Now that's a slowdown from 2021, but it's still a very solid number. And globally, we're forecasting also a more moderate growth from what we saw in 2021, but still a solid 4.25% to 4.75%. Inflation is expected to calm down, right? We're expecting that to calm down. The consumer price index, which is the most well-known measure of inflation, climbed to 6.8% over the last 12 months. through November, according to recent data released just last Friday about from the Labor Department. However, once we move past some of these global supply chain issues and the Fed begins to raise interest rates, we expect inflation to come down. And by the end of 22, we expect it to be just above 3.5%. Although inflation may move a little bit higher in the first part of the year, this is a step in the right direction. We also expect unemployment numbers to come down as well in 2022 as the economy continues to open up. And we expect interest rates to move up in 2022, although gradually. So those are some things that we're expecting. And let's talk about a little bit more about inflation, because I know this is on everyone's list of concerns for 2022. And as you can see, there's two measurements of inflation. One is the consumer price index, as this chart indicates here, the CPI, that's the blue line, okay? And then there's another, and that's typically used by the Labor Department, the consumer price index. But there's another measure of inflation called the personal consumption expenditure. And that's the one that's preferred by the Federal Reserve. And you can see that over time, they tend to move in the same direction, right? They tend to align. And so, you know, but in 2021, nearly everything was in a shortage, right? And it all translated into added inflationary pressures. You know, record numbers of ships waiting at ports, a lack of materials, unfilled job openings, higher commodity prices, a lack of truck drivers, major backlogs, and supply chain disruptions. All of this added to larger price increases in 2021. And you can see that measured here by this blue line, the consumer price index. And so while we believe that these pressures will steadily decrease over time, though, and inflation will eventually settle back to a more normal level. But it's going to take time. It's going to be a gradual process. Supply chain issues may take a while to be fully addressed. Despite these challenges, consumer demand should help drive continued improvement as businesses adapt and address to these challenges. And this is likely to leave us with a positive economic backdrop for at least 2022 and maybe much longer, despite current inflation levels. Now, history shows that stocks tend to outpace inflation over the long term. And this is a valuable reminder now for those investors who are concerned that inflation will make it hard for them to reach their goals. While inflation does have investment implications, over the long run, it doesn't hurt the case for stocks. It actually increases the argument for owning stocks in order to outpace inflation. Also, the stock market, remember, is forward-looking. And if investors really thought that a 6% inflation was the new normal, then stock prices would be much, much lower. The market seems to be pricing in the fact that this level of inflation is short-lived. We'll have to wait and see, of course. One last comment about inflation before I move on. Warren Buffett's longtime business partner, Charlie Munger, once said of inflation, he said, one of the greatest defenses, if you worry about inflation, is not to have a lot of silly needs in your life. And if you don't need a lot of material goods, don't buy them. It's sometimes just as simple as that. So let me move on and talk about, again, you know, I'm not saying that stocks don't like low inflation. They certainly do. In fact, this is a chart which I think you'll find interesting. You know, remember, always go back to the data to support any decisions. This is stock market returns based upon rates of inflation. This goes back to 1950. And you can see the bottom line here is inflation, and then the horizontal line here is the rate of return in the market. And you can see when inflation is basically zero, that stocks do very, very, very well. Okay, do very, very well, averaging almost 25% a year. And as inflation increases, as we go across the right here, the bottom line, when inflation averages 0 to 2%, stocks have averaged about 11% a year. When inflation has averaged 2 to 4%, stocks have done a little bit less. 4 to 6% inflation, stocks have done even less, about 8.7. And if inflation is greater than 6%, you can see stock values actually don't do as well. They're more moderate returns. Now, again, we don't expect inflation to stay where it is now. We expect it to come back down to more modest and more normal levels in the 2 to 4% range at some point later in 2022. And if you go further here to the right, you can see these last two charts here is a measure of, as inflation is moving up, if there's 3 consecutive years of inflation rising, then stock returns are more modest, 6.4% on average. And if inflation, this last one here is measuring if inflation is moving down 3 consecutive years, you can see stock returns are really good. So my point here with this chart is this. If we see rising inflation, it doesn't mean that stocks will lose value. It just means that they may not perform as well. That's all. So that's really interesting to keep this in mind and to look back at history and stock market returns as it relates to inflation. So let's talk about stocks, a little bit further about stocks, staying in the zone. So remember, at the end of the day, corporate earnings drive stock prices. And the prospect for above average economic growth as we move forward will continue to drive stock returns. So this points to another potentially good year for stocks for 2022. Now, while the pandemic is not completely behind us, and there's still several issues we've got to watch, including or particularly inflation, stocks have historically done well in mid-cycle economies. And we believe that we've started, or we're already in, the middle of an economic cycle with at least a few more years left. Historically, if that holds true, the chances of another good year in stocks is quite high. So let's talk about interest rates. And, you know, basically everybody kind of knows that the Fed's going to be raising rates probably sometime before the middle of 2022. We'll probably see that first rate hike. And some people feel that, well, interest rates isn't that bad for stocks, because if interest rates move higher, that means when businesses have to borrow to run their businesses, it's going to cost them more, and the consumer's going to maybe borrow less. So isn't that really not good for stocks when the Fed begins to raise rates? Again, any decisions that one should make regarding their portfolio should be based upon data, right? So we go back and look at the data, and this is a chart that shows how stocks have done when the Fed begins to raise interest rates. And it's really interesting because stocks actually do well. If you look at this chart here, and it goes back to when the Feds first began raising interest rates, the first hike, and it goes back to different periods in time, all the way back to 1987, when the Fed first began to raise interest rates at different periods of time. And it kind of gives you an idea here. Well, 3 months later, after the first rate hike, how did the market do? How about 6 months later? How about 12 months later? And you can really see here in the first 3 months after the Fed raises interest rates, it's kind of a mixed bag, right? You kind of see some downward movement in the market, and you see some periods of time where the market actually moved up, and the average return was basically flat and positive only about 43% of the time. But as you look out a little bit further over the next 6 months and 12 months, you can see the market actually has done quite well after the Fed begins to raise interest rates, after that first rate hike. and actually has averaged over, if when you look at it 12 months later after the Fed has begun to raise interest rates, the average growth in the market or return in the market has actually been over 10% and positive 85% to 86% of the time. So remember, the reason the Fed raises interest rates is because the economy is doing well and inflation becomes a concern. That's why they're raising rates. So it's important to keep that in mind and look at history and allow the data to inform your decisions. So our 2022 stock forecast, higher earnings support further gains for stocks, as we mentioned earlier. So we expect corporate earnings to continue to be strong. Our forecast for the S&P 500, now the S&P 500 is the most broad representation of the US stock market. We expect that the S&P to end at around 5,000 to 5,100. That's about a 10% higher than where we are today. And we expect earnings per share to be right around $220. So if interest rates stay lower now for longer, see, interest rates are going to have a little bit of a bearing on this, but if interest rates do stay lower for longer, this should support earnings and therefore raise stock prices. And in that case, stocks actually may potentially exceed this target by year-end 2022. However, if profit margins face a more intense pressure than anticipated, possibly from increased wages, then earnings may have a harder time of growing in 2022. So this is an interesting chart. I thought I would pull this one up. Some of our clients have seen this chart. And it's important to keep in mind as an investor that pullbacks in the stock market happen and are normal. This is a chart going back 40 years to 1980. And you can see this chart measures the S&P 500 returns, a return to the stock market. That's the blue lines. And you can see that the first thing that stands out to me when I look at this chart is that in only 10 years of the last 40, have stocks actually ended the year lower than where they started. That's the lines that go down from zero. Only 10 times out of the last 40 have there been negative stock market returns. 30 out of 40 have been positive. And this really just goes to show you that in the long run, stocks move forward, stocks gain in the long run. In the short run, anything can happen, right? But if you widen your lens out, the market generally tends to move higher. What's interesting though, is if you look at these black diamonds here, those are pullbacks in the market, when the market actually pulls back. And you can see here in every single year over the last 40 years, there have been market pullbacks. There are generally at least a couple of pullbacks per year. And you can see here that the average pullback has been about 14%. Okay, now some of the, that 14% seems quite high. That's skewed a little bit by some of the pullbacks we've seen here. And for instance, 2008, we saw, of course, a significant downturn in the market. And then we saw a significant downturn here in 2020 when the economy was shut down. But you can see it's really interesting. For instance, if you just pick a year, in 1991, there was a pullback of 5.6%. The market actually ended up about 28%. In 1998, there was a 19% pullback in the market, actually ended up about 25%. So the point here is that pullbacks happen, they're normal. If you've got, I don't know, let's say you've got $1 million portfolio and we see a 10% pullback in the market, well, that's $100,000. Your portfolio could be down $100,000 during that pullback. It's important not to panic and do something you shouldn't do, pull out of the market, because the market generally does come back and certainly over time advances more than it declines. So a very interesting chart, and I thought it would be interesting to go through that with you. So that's stocks. We expect a good year in stocks. We expect a good year in corporate profits. A lot of it is going to be, passing that baton and now seeing how we kind of stand on our own 2 feet when it comes to the economy. But we expect it to be another good year in the market for stocks. Let's talk about bonds, right? And bonds are, always something to consider, and we do include in almost every client's portfolio. So let's talk about bonds. So for 2022, we see, rising inflation expectations, at least during the first part of the year, which are going to be a little bit above historical trends before they calm back down in the latter part of the year. So that, along with improving economic growth expectations, once the Delta variant kind of recedes, these are reasons why we believe that interest rates could move moderately higher from where they are now. In 2022, we expect interest rates to rise moderately over the course of the year. So as interest rates move higher, bond returns are likely to be flat to low single digits in 2022. Not a great year, but we should see an improvement over the negative bond returns we saw in 2021. Now remember, kind of an education here for some of you who may not remember what a bond is. Remember what a bond is, right? So let's talk about the difference between stocks and bonds. So we'll use, let's say, Apple stock as an example. If you own stock in Apple, that means you're an owner, you're a part owner in the company, right? And if Apple does well, they sell a bunch of iPhones and they do really well, well, then your stock value will rise because you are an owner. Well, a bond is not that. It's really kind of just the opposite. A bond represents a lending arrangement. In that example, you're actually lending money to Apple, and Apple is paying you back with interest. Or you might have a government bond where you're lending money to the U.S. Treasury to support their spending, right? So you have a contract, you've lent them money, and they're paying you back with interest. So let's say you own that Apple bond, it's paying you 2%, right? And interest rates in the economy move up. So now the bond that you own with Apple is paying you 2%. I can go buy now because interest rates are higher. Maybe I want to go buy an Apple bond, lend money to Apple. Well, they're going to pay me a higher rate now. So your 2% bond becomes less attractive, right? So the value comes down. So there's an inverse correlation between bonds and interest rates. And so that's why it's important to kind of point that out. So as an investor, a logical question might be, well, if bonds are going to be struggling in 2022, should I just get out of bonds altogether and own nothing but stocks? Well, we don't think so. And there's 2 reasons. Number one, if you sell all your bonds and move to stocks, you're simply exchanging interest rate risk for stock market risk. You're increasing the stock market exposure of your portfolio, and stocks, as we know, can be a bit volatile from time to time. So you're just exchanging risk from interest rate risk to stock market risk, okay? But there's also another reason why you might want to continue to own bonds in your portfolio. As this chart kind of shows you, bonds provide stability to client portfolios. This chart is really interesting, but it goes back to 1993, and the orange line there is the stock market, the S&P 500. The blue line is bonds, as represented by the bond index, and these are drawdowns. These are pullbacks. If you remember, I showed you earlier, the stock market has pullbacks every year, and some of those pullbacks can be rather dramatic. And so you can see that as represented by the orange lines there, that these pullbacks can be volatile. And so but instead, if you look at the blue line, those are the pullbacks that actually occurred in bonds. So look at the stability there that bonds bring to the portfolio. So that's why for most of our clients, bonds still make sense, right? So while stocks provide potential for growth, they can be volatile at times. Even dividend paying stocks can be volatile at times. And bonds have historically provided a way for investors to preserve their capital and diversify their portfolio. They provide stability, and they still play an important role in a well-diversified portfolio. Additionally, as clients need income from their portfolio, withdrawals are typically made from their bond holdings, which allows their stocks to remain invested, especially during times of market pullbacks. So we think that this is very important, and it allows clients to remain committed to their long-term investment goals. So when combined with stocks, bonds help reduce volatility, which makes for a smoother investment experience for clients. And this is especially important for clients who are approaching retirement age, right? Or maybe they're already in retirement. These clients, for the most part, have already accumulated their wealth. And their main objective is to preserve that wealth and to provide a retirement income for the rest of their lives. So that's why bonds play an important role. And also, too, I might add, for some investors, adding some alternative investment strategies, such as high-quality real estate, they also make sense in order to further diversify one's portfolio. So some really good information there. So basically, that kind of concludes what we see for 2022. We did have some questions that came in prior to this meeting, and I wanted to address those questions before we conclude. Okay, so let's take a look at a few questions here. The first question comes from Bruce, and Bruce asks, what does the present market indicate for those of us who are at retirement age, right? And so, very good question, first of all, Bruce, thanks for that. It's important to understand that in the short term, markets can be unpredictable. We looked at that in some of the previous charts. However, in the long term, markets tend to be rather predictable. Historically, there have always been economic and geopolitical issues to be concerned about. And I know that some people are saying, well, this time it's different, right? And the market's going to come crashing down soon. Remember, take emotions out of the equation. It's always important to follow the data, much of which we've just discussed, right? So investing involves risk, and risk cannot be eliminated. However, it can be minimized. So I think the key word for someone who is approaching retirement is diversification. I keep coming back to that, diversification. And once you've worked with your financial advisor to complete your financial plan, which is based upon your financial objectives and your risk tolerance, then you can construct a well-diversified portfolio. And the objective of that portfolio is to achieve the goals of your financial plan while minimizing the downside. It's the whole purpose of financial planning. Then it's simply a matter of thinking long-term, communicating with your advisor regularly, and making adjustments as needed, regardless of present market conditions. So Bruce, I hope that helps you and hope that answered your question for you. So let's go to the next question. This question comes from Ruben. And Ruben, it's actually a two-part question from Ruben. The first part is, what's the projected effect of inflation on market returns? So good question, Ruben. We discussed that earlier in the presentation about inflation and market returns. We do know that, of course, as we discussed previously, we've seen a spike in inflation numbers lately. And so we'll be watching inflation closely as we move into 2022. Inflation should calm down later in the year, as we've discussed. When, we're not quite sure. As we saw earlier, though, in one of those charts, higher inflation, if it's persistent over time, does have a mitigating effect on market returns, right? Now, we don't expect inflation to remain at this level. We think it's short-lived. but it does have a mitigating effect if it hangs around. Now, it doesn't mean stocks lose value, as we saw in that chart. It just means that they may not gain as much. Okay, so this current bout of inflation, even though we feel it might move a bit higher in 2022 before it moves lower, it's leading the Fed to accelerate their plans to end quantitative easing and to raise interest rates. And this may lead to what? Reduced spending, and that's going to reduce inflation. So that's a little bit take on inflation and market returns. If we look at the second part of Ruben's question, it's what are the most likely retirement account actions by our current administration? So great question, Ruben. You know, it's obvious to everybody that the current administration, like all previous administrations, is looking to advance their agenda, right? So in order to accomplish their agenda, revenue has to be raised because they're looking to spend money to accomplish their objectives. So they got to raise some revenue. And of course, there's another way they could look to accomplish their objectives, and that's to reduce spending elsewhere, but we know that rarely happens. So ideas are being floated around to raise revenue, and one such idea is to change the way current retirement plans are regulated and taxed, right? So these are ideas they're floating out there, such as, you know, replacing tax incentives with tax credits within 401k plans, or eliminating the backdoor Roth IRA strategy and eliminating the super IRA strategies, additional taxes on higher income individuals and pass-through businesses like partnerships, sole proprietorships, and S corporations. Remember, proposals are just that. They're simply proposals. And some of these proposals, quite honestly, have already been scrapped in order to churn down the cost of the Build Back Better program. So exactly what changes will occur to retirement savings is, of course, it's unknown, right? We just don't know. The current administration still needs to lock down votes from some of their key colleagues for what's now a dramatically scaled back bill. So barring gridlock in Congress in Washington, which is always a possibility, right? It does appear that some changes are on the way, but they'll likely affect higher income workers earning over $400,000 a year. Most Americans, and quite frankly, most of our clients won't be affected by it. So we'll see what happens. It's also important to point out that the Secure Act was done under the Trump administration, and the Secure Act 2.0, which is bipartisan, just like the first bill, right? So this means that IRA and 401k reform is likely going to continue regardless of which administration is in charge. So we might, be on the lookout for that. Also, don't forget, midterm elections are coming up, right? And the results of which could swing the political pendulum back, and we may have a new congressional makeup, and that new makeup of Congress could reverse any existing tax laws. So important points there, Ruben. I hope that that helped a bit with your question, or your two questions. One more question here that came in from Hans. And Hans' question, he asks, will technology and growth stocks outperform the S&P 500 after the current correction and rotation out due to inflation revaluations? Well, that's kind of a complicated question, a little bit technical. Let me explain to you what Hans means by this question. So the current stock prices of technology and growth stocks are largely based upon earnings anticipated in the future. And as inflation rises, the value of those future earnings is worth less today. So this causes current stock prices of technology and growth stocks to move down. Okay, so that's what he's referring to. If we see continuing inflation, and that's going to affect and lower the prices of technology and growth stocks because that's going to hurt future earnings. So going forward, will technology and growth stocks outperform the S&P 500, which is what we've been experiencing? So we certainly may see some rotation out of technology and growth stocks, at least temporarily, as the economy opens up and as interest rates rise and inflation moves higher. However, remember, it's a different world now, and technology drives the world and should continue to do so long term. So remember that. And also, there's a difference, a big difference between owning an established, profitable technology or growth company and, let's say, a newer technology company that may not even have profitability yet, right? So for the most part, within our client portfolios, we like large U.S. technology and growth companies, which have strong balance sheets, clear competitive advantages, and a long history of profits. So we feel it's important, while we may see some rotation, it's important to continue to own technology and growth stocks as part of a well-diversified portfolio. And I keep coming back to that, as part of a well-diversified portfolio. So those are the questions that came in. Great questions. We really love those questions. If you have any further questions, send them in. We'll address those questions and get back to you at a later date. So let's wrap this up, guys. In conclusion, over the past 2 years, as I mentioned earlier, the increased role of the federal government has given us a hand up to our economy. And no one should find this level of government involvement ideal under anything close to normal circumstances, even if it was necessary to some degree in the face of the pandemic. But remember, the private economy was by no means on the sidelines while this was happening. While some service-based industries were devastated, certainly, by the pandemic, businesses on the whole innovated and they adapted and they evolved. And they positioned themselves well, in my opinion, in our opinion, to take the handoff and run with it, run with that next leg. And our market views reflect that. So while we are watchful of the risks associated with government passing the baton in 2022, we believe that ultimately the economy will be healthier while still managing to create opportunities for investors. As always, remember, it's important to have a sound financial plan, to understand your tolerance for risk, and to have a diversified portfolio. It's also very important to review your portfolio and your financial plan at least annually with your financial advisor. And this will allow you to make any necessary adjustments along the way. So that concludes our webinar today on the outlook for the economy and the markets in 2022. Hope this was educational, informative, and allows you to make informed decisions as you move forward with your financial planning objectives. Thanks for joining us. Much appreciated. Enjoy the rest of your week, the rest of your year if we don't talk to you, and we'll see you next time.